morning, everybody, and welcome to our autumn drinks, our FinTech Circle autumn drinks. And I'm delighted to see you all here and to welcome you to our networking event, which we do once a quarter. And to welcome you in this wonderful location where we are, thanks to Chris, in this beautiful Deloitte headquarters. In order to really get to know each other in person again, because we had 2 years, as you know, COVID, and finally we can meet and network and get to know each other in person, which makes such a huge difference. Today what we are planning to do is, first we will have a few welcome words, then we have a panel discussion with 3 leaders, which I will introduce in a second, followed by more networking, canopies and drinks. So this is our goal for today, and my name, as you know, is Suzanne Chisti. I'm the CEO of FinTech Circle. FinTech Circle is a global FinTech community which we founded in 2014, so we're now 8 years old, and we have got about 200,000 FinTech followers, FinTech members, across the world. And what we do is, on one side, we invest in FinTech startups via our angel investor network. We also write books, so we've written 7 books on various FinTech topics published by Wiley, the US publishing house, and we also work with large institutions to help in their enterprise innovation activities. And the last thing what we have been doing recently in the last 3 years is launching FinTech films together with ITN. And this year our topic was FinTech for Good. So really shining the light on those FinTech companies who do good for society. And I think that's all what all of us, I think, want to pay much more attention to, in terms of ESG, in terms of diversity and inclusion. So how can FinTech companies help with such a thing, such as the pension time bomb? That was one of the conversations at the ITN interview last Friday. So many of us don't have saved enough money for the retirements, and now with crisis, cost of living crisis, we have got this huge deficit, this personal deficit, and what can FinTech do, for example, to help with the pension time bomb, and lots of other things using, various technologies, and that's what we try to cover, on a day-to-day basis. And as part of my team, I've got here Glenn Burgess. Glenn is our marketing director, who will video you, take photos, and we will share those tomorrow, in the next few days, next few weeks as well, with all of our community. And so watch the space to know, maybe we can share highlights where you are also pictured, on across social media. And now I would like to a big thank you to Deloitte Legal, because Deloitte Legal is our partner for our investor activities, for our startup activities, because as any startup founder knows, to get the right legal advice is key for your success. It's key, not just at the beginning when you choose the right investors, it's important when you choose which employees you want to hire, to have the right employment lawyers supporting you. It's important for the contracts you sign, and it's important until IPOs, in fact. Yesterday I went to the London Stock Exchange, and you need the best lawyers to support you for an IPO process. And often, if the valuations don't get reduced at an exit, it's often because legal things have been missed at the beginning. And that's of course what Chris and his team at Deloitte Legal do, is to help make sure that startups have got everything ticked correctly, in terms of the right legal elements, what you need to have in place to have the best foundation for a future successful FinTech company. And so with that said, I want to thank Chris, for being our host today, and I hand over to you for your welcome.
Thank you for that. So hello and welcome to everybody. My name's Chris Hill. I head up the FinTech practice within Deloitte Legal, which is essentially a law firm sitting within the bigger Deloitte network, and forms one of the just one of the very many parts of the broader FinTech team. We've been sponsoring FinTech Circle for, I think it's 3 years now. And through that, we've had the privilege of taking part not only in the investor events themselves, but also in the many selection days. that occur, and through that we've had the opportunity to see some of the very best entrepreneurs and innovations in the market. Now, although Deloitte is perhaps better known for its work with large companies and institutions, there are parts of it, and the FinTech team is very much one of them, that are highly focused on early stage, high growth companies. Why? Because it's exactly in those arenas that many of those really exciting innovations happen that help to shape the economy and the society of the future. And also, frankly, because it's just really interesting and fun stuff to do. As I suspect is the case with a lot of the people in the room, I've been working in or around FinTech since before it was even really called FinTech. And my experience is that the industry works at its very best in those moments where people come together to spark ideas off each other, to identify new areas for collaboration, and with my lawyerly hat on, to help each other to avoid the mistakes of the past. That's why communities like FinTech Circle are so very important, and we're proud to help facilitate this evening's gathering in order to help further that aim of assisting the UK FinTech ecosystem in continuing to thrive even in these sort of very, well, much more difficult economic times. With that, and very much with the idea of shaping the future, I'm going to hand over to Louise Brett, who is our head of FinTech for UK and NSE.
Europe. Just say Europe.
I'll say Europe. Yeah.
Thank you very much. I couldn't miss the opportunity to be here tonight to talk to all of you. Just very, very briefly, this is really Chris's shout. He's done all the hard work of getting this fantastic venue. It's quite hard to get this space, so well done for that. And we're delighted to have FinTech Circle, Suzanne, and all of you here. Yes, I lead FinTech for Deloitte, and it is really important that FinTech is, as you say, a force for good. It's where the innovation is going to happen that's really going to help us and society with all the headwinds that we're currently seeing. I wanted to use 2 minutes to talk about some research we've just completed, and it's coming out. There is a blog that goes out tomorrow, I think, highlighting female financial inequality. And if that's the problem, where's the solution? The industry has to sort out the solution. FinTech is the innovation pointy end of the industry. So I just wanted to read a few stats out to you to say, if this is the problem, how can the FinTech sector be part of the solution? So we interviewed 3,000 plus people through surveys, through diary studies, and through in-depth research. And we found that 41% of women that were surveyed had no confidence in investing. If you're in an inflationary environment, you need to be investing. You have to preserve your wealth in some way, but 41% had no confidence. We also found that that was spurned by not only how they were treated or educated in their early years, they were going to be the budget holders and the caregivers, and the men, or the boys, were going to be the investors, the risk takers, the crypto boys, and they were excluded. This comes out in writ large in the survey. We also found that twice as many men invest, full stop. So in terms of anyone in the investment field, that's an interesting, how are you designing your products and services to attract women? In the career break and the caring responsibilities, of course, women often forgo contributing to pensions. So when we go to the end of their working lives, as they retire to get a pension, and you mentioned the pension gap, which is genderless, frankly, it's appalling, and needs to be solved for. Again, another ask of you as an industry to how can you help do this. But for women, their average pension at age 65 is 1/5 of a man's at that similar point. It's shocking. The other shocking stat for me is, whilst women, unfortunately, when they go through a divorce, or men for that matter, in those situations, only 14% of women will attach the earnings that they are due from their partner's pension. So that's 86% of them don't do that. And we know as a gender, they are so much more disadvantaged when they come to be in retirement. So there's the problem statement. I wanted this opportunity to talk to some of the best brains around that might be part of the solution and say, you know, our ask, sitting here at Deloitte, is how do we engage with FinTech more widely to really solve for some of these challenges? And I was just sharing one of them. So back to you guys, and really looking forward to the discussion. Thank you.
Thank you. Thanks a lot, Louise. Excellent. And I think these problem statements are all challenging and inspiring at the same time for all of us, you know, to work on and to find solutions for. And now what we would like to do is to invite our two panel members on stage, and we have already two companies building some of the solutions actually you mentioned, Louise. So I would like to invite Ollie Cook. Ollie is the CEO of Echo. Please welcome him. Join me, and then I would like Albert Solomon. Albert is the CEO of CMC Invest. Thank you, Ollie and Albert, for joining us today. And what we want to talk about, you come all closer so you can see us all, is about the future of finance and about outlook for the next year, so for 2023. And please, so that you don't have our backs, come closer if you want, you know, come closer to the front here. Don't be shy, exactly. So if I can start with maybe first of all introducing you all. So maybe we start with Albert and with Ollie to do that first. I hand over the microphone.
Shall I go first? Yes. Hi, I'm Ollie Cook, co-founder, CEO of Echo. We're on a mission to empower millions of customers and businesses around the world to take on climate change. We have the firm view that making 1 million people 10, 20% better is better than 10,000 people being 100% perfect. And that's kind of our goal. We do it in a couple of ways. One is we've got our own neobank in the UK that tracks your carbon footprint, offsets it, then uses behavioural economics to figure out ways to help you reduce your carbon footprint through positive reinforcement. We then work with employers to help their employees, and then we serve up all that technology to car providers anywhere in the world to help them empower their own customers and their own fans. I'll come on to the fans a bit later. That's a weird one for us.
Thank you. My name's Albert Solomon. I'm head of CMC Invest. CMC Invest is a new investment platform that's been live for all of 5 weeks. Our mission is to help clients achieve their financial well-being. We're all about helping people build financial security through investments, through long-term planning, through financial goal setting and tracking and hopefully meeting. So some of those stats that we mentioned earlier, as staggering as they are, for us they serve as more motivation to really hit that mission even harder and make sure that we deliver the right solutions, the right tools and the right information for people to help them along that journey.
That's great, thank you. So we have got, yes, one company focused on investing, you know, on basically helping this wealth gap, the pension gap is very long term, and one company, Echo, focused on the environment and how we can make sure that we know what our carbon footprint is and how to reduce it. But if I can start, Chris, with you, and if I can start asking you now in our complex environment, you know, high inflation, we've got cost of living crisis, we've got a difficult funding environment for startups. What should CEOs of fintech companies look for? What are the key things they should focus before they start raising the first round? You know, what are the advice you would give them?
So, from a purely legal perspective, I think the first thing is just to avoid some of the major pitfalls. Make sure you're not walking into any traps. One of those that you routinely get with fintech is that because it's fin, it's dancing in or around the edge of financial regulation. So making sure that you are not doing something that needs to be regulated, for which you need an FCA authorization. And if you do need to getting that sorted or piggybacking off somebody else's license, essentially making sure that your regulatory position is what it should be. The other sort of major trap that people fall into is around privacy. If you're a data-heavy business, it's an immediate red flag for any investor to see that the value in the business that's being derived from that personal data is being derived in a way that's actually breaking the law. So those are sort of two pretty major things that you can and should be dealing with quite quickly. The next thing, aside from all of the sort of more obvious stuff around making sure that you're in compliance with things like EIS, SEIS conditions, if that's what you wanted to use to raise money. It's things like working out what your IP is, because that's often a really big part of the value of the company that any investor is to get at. Is actually your IP. What is your IP as opposed to a third party's IP? How replaceable is it? How much can you defend that? How much can somebody else copy you? Trying to work that out, even if the answer is not that actually you own everything, you've got a sturdy license to keep using that IP, and you've got a strategy, you've got a good answer for it, you will look much better in those early and actually the subsequent investor conversations when you're going through a due diligence exercise. And then last but not least, trying to sort out your contracts. Usually if you're going to get to a position pretty early on, and it's something that we're seeing a lot more now with the economic conditions, is that investors are looking for a shorter path, not just to revenue, but to profitability. You need to go out and get at least some test customers early. You're going to find that much easier if you've got a decent contract in place that you can put in front of a customer, look credible, and get it sorted out and get a deal done and the revenue in quickly.
Great advice, Chris. And I should say, Chris and his team have done a video series of great video interviews or video explanation modules, almost educational modules, where people can learn about, the 5 essential things about fintechs, about different themes, which are relevant for entrepreneurs, and we will share that as well post the event, the link to your website. But that's also very helpful. Now I want to come, Albert, to you. Albert is an example of an intrapreneur. So I don't know if you probably have come across the term intrapreneur. Is somebody working in a large organization, but equally launching his own business. And that's very hard often, because often you get, you have got bureaucracy around you, and you have to do it really well, because you compete with other outside companies who have got, a piece of paper to start with, but equally the advantages, in terms of financial funding. So I wanted to ask Albert, as CEO of CMC Invest, how was your journey? What can you share with us? What is CMC Invest, and what can you share with other maybe entrepreneurs how to make it work?
At the risk of being here all night, I'll try to summarize that. So, entrepreneur is actually a term I'm only recently familiar with, but Suzanne's absolutely right. You've got a different set of challenges. At CMC Invest, as I mentioned earlier, it's an investment platform and designed to help people build wealth over a long period of time. Now that platform's grown out of a company that has been around for over 30 years, is well established, is in the financial markets, but for a completely different purpose. And one of the key things that you have as an entrepreneur is that you are trying to create a personality within a much bigger personality. Funding, we're quite fortunate on that, because we've got key stakeholders, we've got the support. But what you're trying to do is you're trying to carve out a personality for yourself, a way of working, to be more nimble, to be less caught down by bureaucracy and things that have been done in a certain way for multiple decades. Now that has many advantages. You are supported, and that's one of the things that I'd really recommend, is that you get that support. But what you are building, and you're working against in some cases, is a completely different culture. You're going around and you're trying to do something against what other people have been doing for decades. There is that potential for a cultural divide, which we constantly manage, because what you want to do is not, you don't want to be the new shiny thing and then fade out after a little while, but what you want to do is bring people along with on you for the journey. And even though one of the things we found, our business was similar, but it was significantly different. So it's about building the right team around you. It's about doing your best to operate as a startup company and having that hunger, having that drive and the motivation to keep going, and not to fall back on the comfort of a bigger organization. So you get the right team around you. That's been extremely helpful. You build the trust within that team, because no matter what you do, you're never going to have the individual expertise. You're going to have to become the go-to person for multiple things, and you're going to have to problem solve. And one of the things that we've done is to really focus on recruiting people that we can work with, that bring in a different layer and a different degree of expertise. And what I found is that technologists, and to touch on the point before about legal and regulatory, that for us was a bridge. When you bring in some very, very good, capable, technical people, I think explaining the requirements of the regulatory side, which is where we sit and it's very important for us, that was one of those challenges. But I think the most important thing that I found within the team is to really build a team that can trust each other and rely on each other and can drive each other forward. And that was perhaps one of the biggest achievements we have, was once we got to that trust, and then it becomes a beautiful thing and you're working together really well.
Thank you, Albert. Now going to Ollie. So Ollie is CEO of Echo. Is a startup which did not exist 3 years ago. So you will just talk about, it was 3 years ago in the pub with the idea. So Ollie, you have to tell us what drives you to make the world a better place, literally with Echo, and tell us about Echo and your journey.
Yeah, of course, it was actually, Manny, the co-founders, it was about 3 years ago, literally to the day we were in the pub. So it all came from really discussing, and it was just a pub chat around climate change and our personal views. And we were all running businesses, or kind of as individuals, families and stuff. And we all had the same problem, which was I want to do more on climate change, yet I don't really know how. And the things I do know that I should be doing, I don't really know that makes a difference. And then I don't get motivated to do it anyway. So I kind of got to climate change like I go to the gym, in that I do it and then I stop, because I don't really see the benefits quick enough. And therefore, I leave it for 3 months and I go again. And it was the same when we were at businesses, saying I want to do more on climate change, but how do I do this when I make bottles, for example? Okay, I can track the carbon footprint of that, but then I've got an employee team as well, and I've got a company and everything else. How do I track this? How do I do this? And we thought we can solve that. And the reason we did it through fintech is because ultimately fintech runs through the fabric of society. Everything we do, everywhere, runs through a financial service. So we came here, everyone came here, on the tube or however. Financial service provider knows that and therefore can help you reduce your carbon footprint. So we did it through fintech. We were originally called We because we were drunk and we were outside WeWork, and that was why we put it We. And we were hiring a branding agency, and the first thing she said to me is that I'm not working with you if you call We. Well, I like your judgment, so 1, you were hired, and 2, let's rebrand it. And we built the business over 3 years. So the first year, there were 4 of us, and we all had other jobs at a variety of businesses, and that is one of the best decisions we made. And the reason we did that rather than jump straight in is that it gave us time to figure out the product, figure out the business, figure out the commercial model, create the partnerships, without the drive of, I've got a mortgage to pay, I've got to go into XYZ, I need to go and raise money, without my business really thought through. So we took our time, and that was a really good thing. Now, it's also frustrating because I want to go faster, but ultimately I think we are better for being slower to start with, which I don't think any startup really kind of says go slow, but that was kind of a clever thing for us, I think. And then a couple of years ago, we did a big partnership with MasterCard, who supported us all on this journey because they have a huge ambition to help businesses and help their end consumers take on climate change. And then from there, we've grown it over the last 2 years. So we've launched our own neobank in the UK, which is a brilliant bank that looks about positive reinforcement to deliver change. Our card has good vibes written on it, and it really does have that, and it's bright colours, and the idea is to make you smile and reframe your relationship with climate change, that you can do good. And you should, when you get the card out, you get stopped, I'm not even kidding, every day, you get stopped, say, what's that? And it's actually, I'm making my impact every day on climate change, and you feel good about that, and then that has a positive impact. And then from there, we pivoted a lot and expanded. So we work with businesses to help their employees, which is a really big market, and again, businesses need to tackle sustainability in a real meaningful way. I've got, I don't know how many employees Deloitte have, let's say 100,000. 320,000 people.
Yeah.
Deloitte can look at themselves to figure out the carbon footprint, but actually you've got 320,000 people you can influence. That's incredible. We can help there. And then we sell that to other banks and other card providers around the world. And the reason I said fans earlier is we did a weird partnership with Champions League football clubs who really care about climate change, and they really don't know what to do about it. So we're working with the likes of Real Madrid, Glasgow Rangers, AC Milan to empower their fan base to figure out their climate change, their carbon footprint when they go to a football match or when they go and by tickets when they travel to go and see an away game, and then offset that and help them reduce it. And if you did like a diagram of football fans and people who care about climate, I might be wrong here, but I don't think there's a massive overlap. But wouldn't it be amazing if people were passionate about climate as they are around the football teams? That would be an incredible opportunity. So we now do that, and that came about from another chat, another networking event, and we built it from there. I could keep going, but I'll stop for a bit.
Fantastic. That's great. So it's kind of football fans who can pay with the Echo card in order to know their carbon footprint and reduce their carbon footprint, basically. Yes,
yeah.
Excellent. That's great, Ollie. So now, I think you heard from CMC Invest, you heard from Echo, you heard from Deloitte Legal. And one thing I know, which what fintech startups, lots of fintech startup founders talk about now is fundraising. And of course, we are in an environment where fundraising is a difficult one because of the current decline, in fundraising activity from early stage to late stage. Even at the IPOs, normally the IPO windows is closed at the moment. So we had more than half of less IPOs at London Stock Exchange this year. But we see it early stage. We see it on angel networks, where we see less funding is available because investors sitting on the sidelines are waiting and don't want to deploy their capital at this stage. So from your point, Chris, where you see lots of investor activities, you see lots of startups going through the fundraising journey, what is your best advice in a difficult time like we face today?
So I think the first thing is really an enhancement of the principles that generally apply when you're trying to get investment. Make sure the product's good. I mentioned earlier kind of the path to not just revenue, but profitability. Like you said, the investors are sitting on the sidelines, but that capital is there. It can be deployed, but they're more hesitant about deploying it. So if you're going to persuade them, it's a greater act of advocacy to get them to a point of saying, yeah, actually, even though the valuations may change over the next 6 months, let's go and do this now because we don't want to miss out on the opportunity. So the things that feed into that, firstly, it's that path to profitability. Secondly, it's the real gap in the market. Thirdly, it can be things that help them to, in the nicest possible way, tick a box that they want to tick. That sounds kind of cynical. It's really help them to achieve an aim that they want to achieve. So ESG is a really good example. You've seen a lot of really good stories recently around ESG investment. There isn't a magic bullet, I'm afraid, for trying to break through into that market. What I think we've seen over the past 3 or 4 months in particular is, frankly, a bit of a threshing, because some of the weaker ideas that were previously getting investment on a little bit of a whim, it's like they've got a massive customer base, we don't know what their revenue model is or what their profitability model is, but we'll work it out later. That has stopped quite a lot, or certainly slowed an awful lot. Seeing a lot more conversations in the later stages of investments, or rather later stages of developments that are more around debt rather than equity. I was chatting to one of the corporate partners earlier on. He was saying he'd had 5 times the number of conversations about debt versus equity in the past few months than he's ever had. I think those factors all fit together. It's also about kind of finding the right investors that have those same passions and really want to kind of drive forward in the area that your product helps them to drive forward.
Fantastic. That's a great advice. And of course, we've got investors here in the room. I won't highlight them now, but we have got wonderful investors here who did great investment deals, who had wonderful exits already behind them. So it's important to choose the right investors, And I remember some of the CEOs I've spoken to, and one specifically, he said to me he only accepts investors whom he likes to go for lunch with. Because you can't get rid of them. Once they're on your cap table, it's very difficult to not deal with them. We have to. So choose them wisely as well. It's a two-way conversation. So talking about data as well. Data, as we all know, it's the new oil. All of our fintech companies use lots of data. And it is important how to treat data well, because it's a strategic asset. But of course, there are also legal responsibilities, clearly. So I wanted to ask you, Albert, what's your approach towards data and monetization of data?
Yeah, I mean, the way that we look at data and sort of in line with our mission to have this personalized investment platform that helps you achieve your unique goals, is to really see how we can harness the data that we have on you and the transactions, for example, that we see, to really tailor and personalize that experience, and to serve up things for you that would help you achieve what you're trying to achieve. So you're not, investments are, it's a tricky proposition, and some of those stats that we heard earlier on. And you do find with people that have been investing for decades, there are still traps that they fall into. And I always wonder, one of the things that we could ultimately do is use their habits, their own information that we have on them, to help them along that journey, to help them not fall into the same mistakes, to help them track how they're achieving. So for us, the use of data is really critical in that it can help us achieve our aim of personalising the service and making it more a tool for the client to achieve what their ultimate goals are. Now, as I mentioned, the risks and obviously the data being the new oil, the risk for us is both regulatory as well as security. We do retain quite a lot of information on people in terms of, you know, what we were saying earlier about fintech and the things that the transactions they enter, bank details, all that sort of stuff. And for us, it's critical to protect that. So the risk to the downside is making sure that data is adequately protected, both from the incorrect external use as well as the incorrect internal use.
Chris, any comments from your legal side?
Many more than you will want to hear. So I've always thought this sort of data is the new oil thing is quite an interesting paradigm. In one respect, it's correct because it can be set on fire and cause an awful lot of damage. In another respect, it's not quite right because one of the bizarre things about data is that it's replicable without loss. You can create as many copies as you like without the original bit being lost. We deal with data a lot, you can imagine. An awful lot of fintechs have some heavily data fueled, some brilliant stuff you can do these days. There's a phrase that was used in an article that I read many moons ago. I think about Apple tracking people, tracking location data, which was it's kind of cool but kind of creepy. And there's always that fine line to tread, and that's an awful lot of what privacy legislation these days does. Is it's looking to define that sort of consent boundary of actually, yes, you can. It is technically possible to do that stuff with the data, but is it starting to impinge on how people feel comfortable with how that data is being used? So personalization journeys is a really good example of that. One of the things that I see happen quite a lot, it's worth sort of just very briefly outlining. We have a very good video on this, which you should look at. It's not very long. Is the myriad of different rights and things and different obligations you get around data. So you never people default to thinking about privacy. It's not just privacy. It's privacy overlaid with IP and confidentiality and in many cases financial regulation as well. In order to do data well, you really have to work out what it is you actually want and need to do with data and set up your processes, set up your systems so that it's only doing that. It's really easy just to hold on to big stores of data and to start doing stuff internally with it that you shouldn't be doing with it. If you're going to make an effective use of it, and without getting into kind of legal difficulties, it takes more focus, it takes more concentration to manage those big data sources. People talk about data lakes, which fills me with fear. To manage those in a way that actually corresponds to what your users have consented to what you actually need. One of the things that often gets missed is people holding on to personal data when they don't need to. You can get the use that you need out of that data often by extrapolating up 1 or 2 or 3 levels to the point where it's no longer actually personal data anymore, but it's still got the value to you. It's always a tightrope, a very complex tightrope to tread, but it needs the focus, it needs the time, and with that focus and time to get things in the right order, there's huge possibilities and value that can be extracted from that.
Give advice, Chris. Thank you, Albert, as well. One thing I wanted to share with you is we published a white paper just last week, which is called the Data Barometer. And this data barometer is analyzing where and how do you store the data you create? And in terms of environmental impact, in fact, because we all use data centers, some of them we put them in the cloud, but how energy efficient is it? Because the more data we use, the more data we store, and there are places such as Norway, for example, or kind of energy, friendly countries where data can be stored in a way which is 100% green. And all this is part of your own, scope 2 emissions that you think of as a company's track record. So very important, and I encourage you to have a look at this white paper, very interesting read. So now I've got a few more questions, but before I do that, I wanted to ask our guests here if you've got any questions for our panel members. So just raise your hand, and I will give the microphone to you. So if anybody has got a question ready in the audience. Yes, please, you've got one here.
Hi, going back to debt versus equity. Lots of fun and games with equity. Do you care to elaborate?
Short answer, no. Because I'm not the corporate lawyer that does the investment stuff. I think things that I've seen going on over the past few months, it's largely about valuation. It's largely about sort of smaller companies being pushed into a corner that they shouldn't really have been pushed into because of people looking at market conditions, either just being cautious or frankly just overplaying their hand, which I think in many cases will end up shooting themselves in the foot, because the worst that could happen is that people hold on to the capital for so long that there's not the things to invest in that they would have wanted to invest in. It's kind of best to actually just take the plunge. I think the other bit that I've seen is a little bit around things where companies that I would have expected a year ago to have raised a really convincing Series B, Series C, not quite getting that because of board trouble, people being worried about economic outlook, and again largely just because of that valuation point, and the founders just can't quite agree to the terms that are being put in front of them. So yeah, there's been some difficult stuff happening. Do I think longer term it's a very big problem? I'm actually relatively optimistic about it because I think there are a couple of market corrections that are likely to happen. I think there has been a market correction that's gone slightly too far, the wrong way, but I think that is likely, and it's just my opinion, it's not a broad Deloitte opinion, but I think it's likely that people start to see, look, these are actually really good companies. I think the fintechs themselves are going to have to do more to prove that they are good companies in order to get that investment, but I think it's still possible to take advantage of those capital opportunities that are out there.
Great. Any yes or one question here?
It's just a general question about, I mean, it feels like to me the market at the moment is super saturated in terms of sort of fintech space as well, right? Like traditionally in the last couple of years, VCs invested a lot of money into general fintech, and now it's about understanding valuations comparative to competitive advantage. So what are you doing to differentiate? And also, how are you kind of monitoring your competition generally? Like, what does that look like for you?
Question. So let me hand over to Ollie.
It's a long walk. Yes. Yeah, that's a really good question. I think you're right. It's really saturated, and you all need to look at Novus recently announced they've ditched the whole B2C offering for, I don't know why, but for got reasons. I think it's really saturated. I think the difference for us is we're a platform business. We have D2C, we have employees, we have other banks we work with. We're a platform with a model. We're kind of agnostic as where it goes. I think D2C businesses alone are really going to struggle. And I almost see it as an opportunity for perhaps this whole shakedown that's going to happen. That might be a good thing, that we kind of strip it back to businesses that have solid financial models, solid plans. That's not necessarily bad. What I worry more about is big businesses, D2C or otherwise, in the fintech space who go under in the next 12 months, and what that does to investors, and if that spooks everyone, and then people who may be starting out with genuinely good business models are affected because one of the big people went. I think that would be a really dangerous game for all of us. I think that's a real worry for us. But in terms of monitoring other people, you know what? This is interesting, I guess. For me, I've stopped looking to a certain extent because it's a nightmare, and it's really not good for you, because a lot of the stuff when you're smaller, I find, is the stuff that's public isn't necessarily the stuff that's actually happening. You've got a load of other stuff going on that no one knows about, and that's your secret sauce. So monitoring what other people are up to at a smaller scale doesn't really help. You learn from them, but I don't worry about other people.
Albert, what are your thoughts?
No, totally agree on that last part. I think you can go around in circles just focusing on everybody else. I think as long as you're comfortable in your own mission, you're clear in your own targets, I think the competition will do what the competition does. And as long as you're comfortable that your strategy and your way of offering something of value, I think if you're confident in that, you can just focus on that, and you're right, you lose a lot less. Well, you gain a lot more sleep and lose a lot less sleep.
Excellent. Other questions? Yes, please.
Yeah, thanks for your time. Going back to the first question, so we're living in a crazy time where you've got founders' valuations which are very different to investor valuations, and the fair value of a company is very different to what investors see it as. And like you said, we're being pushed down as founders. And maybe this is a question more from a legal standpoint, what are some of the better ways to sort of bridge through this hopefully short time of market correction? Is it convertible loan notes? Is it other instruments that can convert later to equity? What are you seeing as some of the better ways to sort of get through this difficult time from a funding perspective?
Good question. Do you want to comment?
I'll try. I know enough to be dangerous. Convertible loan notes is something I've seen a bit more of for kind of obvious reasons. I've seen some people try and get debt and not get very far with it for kind of obvious reasons too early stage. But beyond that, it's people doing stuff that it's sort of renegotiating some contracts on the basis of things like supply contracts in. It's people doing smart stuff around their employees saying, well, actually we really need you, but we can't fully afford you right now. Can you go down to X days a week and we'll do something later on? And there's quite a lot of trust involved in that. I don't think, unfortunately, there is a magic bullet, because I think if there was, then everybody would be doing it. But again, I'm not the expert. I'm the contract and reg guy rather than the investment guy. But so there are others who know more about this than me. I'd be interested in views around the room actually about what people have found, which is maybe something you can pick up over a drink.
Yes. Good. Yes, please.
Yeah, hi, Chris. It's JP Agrawal. Just a related question, really. I mean, in the current budget or mini budget, there was good news, obviously, right, on SEIS or EIS investment. Now, one thing UK differs from the US market for the startup investing is the safe notes are very popular in US as opposed to here, simply because I would think about the equity here, subscription gives you the tax advantage to the investor. Now that creates also a big problem because the startups don't have a valuation, right? I mean, valuations is pretty much a guess, right? Which also is a problem for getting the investment, because people want to invest in equity, but then the valuation startup would get a higher or lower valuation depending upon where they are. Now, is there a way to tackle this problem and potentially ask the H&M Treasury, I know it's a big task, to make that convertibles as well tax eligible for SEIS or EIS investment? And that would really sort out the problem, really. I don't know what your views are. Is there any other solution? Thank you.
I mean, if I can answer, and I'm happy to anybody else to add, I think this would be the best solution, because the point you said about convertibles, is used in the States as the solution for early stage investing. It's not so much used in the UK because it's not SEIS eligible or EIS eligible. So we've got this, gap. And if we would make convertible notes, SEIS, EIS eligible, we would solve the issue which we currently have. And but I don't know which lobbying organization would be able to address that. But I think this would be, one of the best things, because at the moment the mini budget, of course, increased You know, the SEIS limited to £250,000, which is a huge benefit, but does not solve the valuation issue. I think yes, you would like to add something, Max?
No, what I was going to say was a convertible loan.
Yes.
Don't call it loan, sorry, convertible. As long as it's compulsorily convertible, you're still eligible for EIS. Okay? All that you got to do is, for example, in the case of ASA, you got to convert it in 6 months. But otherwise, yes, you can have a convertible as long as it's compulsorily convertible and there is no interest paid on it. Okay? Because you can't pay interest and then claim even EIS thereafter. Normally, I mean, if you give loan to a company, then you're not even eligible for EIS subsequently. So you've got to be careful about that. But it is possible.
Previously, the time frame was 12 months rather than 6 months.
Yeah, I don't know if they've extended now, but I've not done the latest. I mean, not done any convertible lately. But the 250K as well has not been legislated yet. So you've got to be very careful about some of these things. There's still 150K, and we don't even know if it's going to be thrown out or it's going to be accommodated. So lots of things that have not been passed yet.
Great. That's great, Max. Thank you. The other thing, what we do at FinTech Circle, just to let you know, we are partnering with a FinTech, with a technology fund, again this year, which we did it already this year, so we do it again for next quarter. And this is a fund where all SEIS investors come together, EIS investors come together, and we can deploy the fund allocation in FinTech at a much larger scale. So we know that we've got guaranteed funding behind us. And for those of you who look for funding, you know, for SEIS, the deadline to apply will be by the end of this year, and our selection days will be beginning of next year. So this is an opportunity to tap into this FinTech SEIS pool, you know, which is coming in partnership with a fund in the UK, so that we have got the ability to fund more startups in one go before the tax year ends, you know, on the 8th of April next year. Business clients and your personal clients, you know, how do you make them feel? What are the concrete benefits, you know, by using your card? And how can your corporate clients scale up the services? Do you know how to support them?
Yeah, it's a great question. I think when it comes to climate, the majority of people care. I think one of the problems we face is a lot of us care about it, but it's not the top of my priority list. Whether I'm a business, whether I'm a consumer, ultimately there are other things higher, let's say family, security, jobs, etc., are above climate. And the way we want to tackle that is helping these people by doing it effortlessly. So using our technology, whether you're a consumer, a business, another bank, we can track your carbon footprint in real time based on what you transact. We offset that transaction so you know you can live carbon neutral on our technology platform, which is great. But then importantly, you can't offset your way out of the challenge that we face. That's not a thing. People shouldn't assume that's true. Instead, you have to reduce it. So it's using our behavioural economics to help you figure out ways to reduce your personal impact. What we found when we're speaking to businesses specifically, actually, is they really want to do something and yet don't really know how. And what I'm finding about the climate tech space is the collaboration is incredible. I've worked in big banks, I've worked in SureTech, I've worked in small banks, and everyone's kind of got their, I'll tell you a little bit, and I won't really collaborate too much. We'll say we'll, but we won't. But in this space, everyone's willing to work together and communicate and kind of figure out the problem, which is phenomenal, and it's totally different from anything I've experienced before. So you speak to a big bank, they don't know how to solve this problem, they're willing to work with Fintechs, speak to football clubs, consumers, everyone's in the same space, and it's quite a nice environment to be in. And then equally, the gentleman over there talking about the competitors, I speak to our competitors regularly about how we can help solve the industry problem and how can we help solve that, and it's totally different.
Excellent, that's wonderful to hear.
Good, Ollie. Any other questions before yes please, I've got one here.
So, at what point do you think ESG is going to stop being an effective marketing term and people start actually looking for solid returns on actually getting more money out of their investment than they actually put in?
So ESG is an asset class, it's an investment. I think maybe both of you can respond to this.
Yeah, so is it a marketing term? Yeah, I think people do use it that way, but I think those people get found out eventually, as per HSBC, a week ago, which is different. I think what I'm very keen on and what we've always been purposeful on is profit with purpose. We are unapologetic that we make profit and we're profitable in the next 12 to 18 months. And I'm totally comfortable with giving investors shareholder return whilst also evidencing mathematically that we have reduced people's carbon footprint and we have helped them improve their own sustainability. I think that's perfectly fine. I think there's a difference between a brand with their, if you go to Frederick Smith's, they've got a eco range, which I have a bit of a problem with because they've got 95% of the business isn't, and therefore that is pure spin as far as I'm concerned, versus a business whose DNA is already there and are doing it from startup. So I think there is a slight difference there. I think these bigger businesses, we shouldn't necessarily, I have another view on it, which is if you are a big business and trying to do good in this space, we can't come down on you when you don't get it perfect, because that'll mean that people won't do anything, and that's bad for us all. So we've got to be really careful not to push people to an element that says, I won't even try because I'm going to get done in the press for it, because that's not good for us. There's some balance there to be done.
Yeah, sure. And I guess from our perspective, our ESG angle is to make it more than marketing. It's to really make it about the individual and what's important to them. So if we can give you information, and I don't think it's a mutually exclusive thing to be ethical and to get investment returns. I think from our approach is to give you the information you need to work out what's ethical to you and what ESG means to you individually, not to try to bring some sort of an overlay or some marketing spiel. It's to make it about what you think you want to be involved in, and to make sure you can see through the information that's out there to understand how any particular business profits. But I wouldn't say that we would just lump it into any one category and say that's a return on ESG. It's what the individual is comfortable in investing in.
I think it's another point to make in that, which is the reason that it's possible for it to be a marketing term at all is because it's something that people respond to. That's why people use it for marketing, because there's an infinitely larger body of consumers now that are interested in this as a theme, just like I was saying, for that to be something that drives choices. So to the extent that ESG is a term that is a differentiator, well, one would hope that eventually it's just something that's so embedded that it's no longer a differentiator and therefore no longer a marketing term. It may well be, and I think it already is to an extent, that regulation and legislation has a big part to play in that. For the moment, I think it's a very positive thing that it is seen as a marketing term, that people do care about enough to make those choices on that basis.
Great, so now coming to our last question, which is really about looking into the future. And any other questions I know that you'd like to ask, we can do that over drinks and canopies, so we have got more time tonight. But the last question is about the future, looking at the metaverse, looking at Web 3.0, looking at what the next year will mean to all of us, about digital assets potentially, what are we all concerned about? And so I wanted to ask each of you to let us know what your plans are for the next year, your priorities, and how you look at the future.
Thank you. I think we plan to offer, again, an investment platform that suits what people, how they want to invest and what they want to invest in. So I think for us, one question that still pops up is crypto, and what we'd like to see is a final decision and a landing on regulation of crypto, because I think once that comes into place, that really sets the boundaries and enables us to offer it as a credible asset class in a way that people can invest with a certain degree of security. So my hope for 2023 is that we do get some more clarity, and I do believe there is some good momentum in this space. So that's what we plan to work around.
So I'll probably get more on the markets are a nightmare. I think everyone's aware of that, and the funding, etc. I think we're viewing it more as trying to be positive. We've got the here, we're doing well, and it's the opportunity for 2023. And I think as the shakedown happens over the next 6 to 9 months, there's opportunities for collaboration to help each other to figure out ways of solving problems together. We equally partner with other people to solve problems. So we're viewing the next 12, 18 months as an opportunity to partnership with people, and an opportunity to equally take market share as well, because there's opportunity out there, there's a shakedown happening, there's space for us.
I agree with all that. I think, so on the crypto point, I think regulation is a very, very good thing. I think it's been under-regulated, horribly under-regulated by a fluke of technological circumstance for a very long time. And I think that regulation will be a threshing that is really overdue. In terms of what happens in the markets, I think I very much hope that correction is going to continue to happen. The slump that's been happening on the fear of awful headwinds, that people actually realize, like, we do have capital, we do need to deploy it, there are businesses and good ideas that we can make money from, we need to get on and do that. More generally, I think the topic that everyone stopped talking about, but it's still very much there, is Brexit. There, I said it was 40 minutes in, whatever. We're starting to see some of that a bit more. And I think I've talked in these forums before about, I'm not a Brexiteer, I've never been a Brexiteer, but even I see that there is a real opportunity for a government that is not part of a much larger committee to make decisions quickly that respond appropriately to changes in technology and business models to make it a better and more welcoming place for businesses like Fintechs to establish themselves and grow.
Fantastic last thoughts. I guess from our side, FinTech Circle, we see lots of new innovation taking place across the whole digital asset space, across blockchain technologies, and we don't believe that this will take over the old world or the existing world, but we think we will coexist. So when we think about Web 3.0, it will coexist with our current infrastructure. And the companies, I think the key issue of what we see is interoperability. Because if you are a payment company, ideally you want to be able to transact your payments both on SWIFT, but also using DLT technology, and how you can provide this on-off ramps. I think that's what is here to be solved, and is not yet being solved yet. That's when great opportunities are for entrepreneurs, to work on. So with that said, I would like to thank our panel members. Thank you all very much. All three of you, it was great to have you with us. And thank you all, for being here. And now we can have many more conversations, and you please feel free to come up with questions. We have got now more private time to chat over a glass of wine, a glass of champagne, beer is here, and more food to come as well. So thank you very much for joining us, and stay with us and have more networking time. Thank you.